Hello traders and welcome back. In this lecture, we're going to be learning about correlation in Forex trading. Correlation is a concept, a very important concept in Forex trading that unfortunately many do not know about. And this affects our risk exposure in the market if not done properly. Okay. So if not taken into consideration, it can affect our risk exposure. It can accelerate how fast we lose or how magnifying our losses are. So what is correlation, right? Correlation in Forex is positive or negative relationship between two separate currency pairs. A positive correlation means that two currency pairs move in positive directions. That's in the same direction. And a negative correlation means that they move in opposite directions. That's in opposite directions, right? Yeah. So correlation can make you double your risks in the market without even knowing it. That's the unfortunate thing about it. So let's say you risk 3% and then that's on each trade, and you took positions in two trades that are positively correlated. So you took, let's say, the same directions. Let's say you buy the both currencies and they are positively correlated. And you risk 3% on each one. Without you knowing it, you are basically risking 6%. Because if one trade hits your stop loss, the other one will automatically hit your stop loss because it is positively correlated to the other one. So these are two currency pairs. We have GBP USD 1 week. We have Euro USD 1 week. And we can see a similar kind of movement between the two currency pairs. Now, let's just do a little drawing on them to explain better. Now, you see here is a clear uptrend. Here also is a clear uptrend. Here is a bit of consolidation. Here also is a bit of consolidation. Then clear downtrend, bit of consolidation, a clear uptrend, bit of consolidation, and a clear downtrend, so as you can see, they are basically moving in the same direction. It means they are positively correlated. Now I'm going to trading view. Okay, we have GBP USD here also. Now when you check GBP JPY, you also realize that they are correlated. Okay, GBP JPY, right? Now look at GBP USD. Tend to see that the movement is kind of similar. So we have positive correlation, we have negative correlation. In pairs where they are negatively correlated, instead of you seeing a direct representation or a similarity between the movements on the chart, you're going to see a direct opposite of the movements on the chart. Okay, so that's it about correlation. So let me take, for example, let's assume we enter a trade here. Let's assume we can see from here to here. Okay, and then we enter a trade here. So we enter a trade here, hoping that the market will continue buying, right? And that's on GBP USD. And on GBP JPY, we also enter a trade here. That's, of course, at the same position, at the same level, and then hoping that it goes here in our direction. So we risk 3% here and we risk 3% here. That's on GBP USD, right? As you can see, the market actually went in our direction and we won both GBP USD and GBP JPY, right? But what if the market went against us? What if the market went against us? It means we'll be losing both GBP JPY and GBP USD because they are positively correlated. Now, this next site is myfxbook.com. You can see the link here. Just copy it and go to the site. This site will show you more about correlation. Will show you currency pairs and their level of correlation or their percentage of correlation. So there are currency pairs here and there are currency pairs here. We can see AUD card and AUD card, which are positively correlated, of course, because they are the same currencies. We have AUD JPY and AUD card. They are 28.7% correlated. We have AUD JPY and AUD CHF, which are 33.1% correlated. Okay, so you don't have to worry about the little ones. the ones you have to worry, correlation values which you have to worry about are values that are about 80% upwards. Okay, so let's just say 75% upwards or 80% upwards. The higher, the more. Okay, so the stronger the correlation, the more damage it can have on your risk exposure. What causes these currencies to be correlated? So the currencies, we have them. For example, we have what we say is GBP, JPY. Sorry, my writing is very poor. And then GBP, USD. GBP, JPY, and GBP, USD. So as you can see, the presence of GBP here makes them very correlated, because we have GBP here and we have GBP here. Okay, so the presence of GBP makes it very correlated. And then in some cases whereby we don't have the currencies structured like this, some of the things that cause correlation in those cases are like similarities of countries, okay, similarities in time zones, similarities in the economies of the countries. We have countries like United States of America and Canada, which are very much similar, and their economies are also similar. So these are some of the things that cause correlation between currencies. Okay, these are some of the things that cause correlations between currencies. So what should you do if you are faced with situations like this, whereby you want to take trades on correlated pairs? Let's say you see good setups on both pairs and you want to take those trades. What can you do to reduce your risks? Okay, to reduce your risks. So the first thing you can do is you can choose the best setup. So you can choose the best setup. We have GBP, USD here, and we have GBP, JPY. You can just check, okay, you can just check which one of them meets the criteria for your strategy the most. So choose that one and then take the trade on that one. And then if you want to take extra trades, you can take extra trades if and only when you have the present trade at zero risk. Remember, we spoke about break even and trailing stops in the last video. So zero risk is when, of course, you have your stop loss at break even, right? So when you have your stop loss at break even, you can take extra trades in the same currency pair, on the same currency pair, or on a positively correlated currency pair, right? Then one other thing you can do is you can kind of split your risks between the both pairs. So let's assume you want to risk 2% or 3% per trade. What you then do is you risk 1.5% on one of them and 1.5% on the other, so as to split your risk, so you don't have to risk the whole 3% on each of the trades. One other thing I do is I come on something like this. Now this is called the currency strength meter. Currency strength meter, it basically tells us the strength of our currencies, okay, based on a certain time period. Okay, so if you refresh this, you might see changes on the currency strength, as you can see. Okay, so this is GBP, this is Euro, this is USD, and so on and so forth. You can come on this site by just coming to your browser and type currency strength meter. When you type currency strength meter, you then look for where it says livecharts.co.uk, and just click it and you'll be brought to this page. So the currency strength meter tells us the strength of each currency at a particular point. So as you can see, at this point we have GBP as the strongest, we have USD as the next strongest, we have Euro, we have AUD and JPY as the weakest, we have these other ones. So let's assume we are in a situation like this, where we have seen the setup on GBP, JPY, and GBP, USD. When I come to my currency strength meter, I see that GBP is strong, USD is strong, and JPY is weak. Now I have a setup to buy GBP, JPY, and GBP, USD, right? Now looking at this tells me that if I buy GBP, USD, it's going to be harder for the trade to proceed in my direction. Why? Because GBP is the strongest and USD is not weak. USD is kind of the next strongest, not as strong as GBP, but a little bit stronger, which means it's going to give much resistance, quite much resistance, okay, to my movements going up. But if I am to use GBP, GPY, okay, I look at GBP and I look at GPY. I see that GPY is the weakest and then GBP is the strongest. So it's going to be easier to buy GBP, GPY and also have a good winning trade, because GBP will move against JPY much easier because JPY is the weakest. Okay, so the currency strength meter is a very important tool. By simply buying the strongest currency against the weakest currency, you will most likely be making money. Okay, because the strongest currencies will have less resistance when traded alongside the weakest currencies. So these are the ways I navigate the hurdles of correlation. Okay, so now we've come to the end of our lecture on correlation. The next lecture, we're going to look at even more ways of managing our risk and limiting our risks in the market. Hope to see you there.